I have Luke Ofojebe, the head of research at Vetiva Capital. He joins me now as we look at the drivers of the markets today. Thank you so much for your time today, Luke. And let's first get what we're seeing play out in terms of sentiments today and how the week has started so far.
Thank you very much for having me here today. So far in the markets, it's been more of mixed trading. So a couple of weeks back, we saw more of a positive trend when investors started taking positions in a number of stocks, which wasn't surprising to us because for a number of companies listed on the exchange, we actually noticed like an improvement in their Q1 performance. Turnover increased significantly, same for bottom line. And as a result of that, we saw renewed investment appetite in the equity market. This was further driven by the low yield environment we have in the fixed income space. Currently, interest rates in the fixed income markets for the government treasury bills is around 3 to 5%. That's really lower than current inflation levels, and that's also attracting investors into the equity market. So that's really helped to support positive trading over the last 2 weeks. But more recently, we noticed that investors have started taking profits in the markets. And given what we saw today, some heavy counters also declined because of today's trading session, like MTN and a couple of other big names. And we think this pattern might continue for the rest of the week.
Yeah, definitely quite a lot to consider there because we've seen that profit-taking activity show up in players like Lafarge Africa, MTN Nigeria, and even International Breweries yesterday taking the big hit in that space. But looking at how the market has been so far this quarter, quite impressive when you see that year-to-date the market is up about 24%. We're seeing about 30% this quarter so far. And I'd like to get your projection in terms of your outlook for the rest of the quarter. Do you see this momentum continuing, or are we going to see more of a decline from here?
Quite an interesting question. I think for us to be able to share the outlook correctly with you guys, you also need to understand where we are coming from and why the market has returned over 20% year to date. So unlike what we find in other markets, especially in advanced markets like the US or the European markets, where you can see negative returns, and even in other developing markets due to tensions between Russia and Ukraine. Here in Nigeria, that's not the case, which a number of investors might find surprising. But you also need to understand that a number of portfolio investors had already exited in the Nigerian equity markets. So the market right now is dominated by local players, and they are the ones actually driving this positive sentiment. So in subsequent quarters, it's very likely that we'll continue to see an improvement in the equity market. However, the big risk to watch out for is inflation. I mean, looking at latest inflation figures for the month of April, headline inflation came in around 16.8%. That's worrisome. If that trend is going to persist for the coming months, so we might see inflation getting to as high as 19-20%, and that can translate to higher operating costs for a number of companies and consequently weaken margins for them, which might result in lower profitability, and that can drag trading sentiment in the coming months. But overall, we do expect that higher turnover from a number of companies, especially for companies in the telecommunication space, oil and gas, industrial goods. We do expect that higher revenue performance for these companies should support their profitability, and that should further help to support trading sentiment. And also coupled with the fact that yes, the US Fed has recently raised rates, same for the monetary authority in the European markets and other developing markets. Here in Nigeria, the body language we're getting for the CBN is to maintain rates at current levels. So even though rates might go up in the second half of the year, we do not expect rates to rise to as high as 12-13% like it was before the pandemic. So what this means is that the low yield environment is going to persist, and that should further attract more investment in the equity markets. the second half of the year and consequently support trading sentiment.
But look, how's the market interpreting the inflation environment now? Yeah, we saw the printout from yesterday, hit quite a higher from the last for about 8 months again. And I'm trying to understand for you though, especially for sectors like the consumer goods and industrial goods though, you know how you see the impact playing out, the inflation pressure we're seeing?
It's worrisome when you are looking at the latest inflation. I mean, headline inflation around 16.8%. This is very worrisome. So I think right now, what investors want to do in terms of trading strategy would be to maintain exposure to companies that can actually grow their revenue in such a way that they can be able to subdue the effect of inflationary pressures. And in this case, I'm talking about companies in the telecommunication space. I mean, look at MTN, for instance. Revenue for the company has been growing at a rapid rate, and that's supported by data revenue. Then for the oil and gas space, I mean, for the upstream space anyway, the narrative is clear for everyone to see. We're in a period of high oil prices, and that's really supporting revenue for companies like Seplat. Then for industrial goods, improvements in government capex disbursement should continue to support turnover for this company. And also coupled with the fact that we are now at a time when the private sector's consumption of cement is actually increasing at a rapid rate, and that's also supporting turnover for industrial goods players. So for these companies, the expectation is that revenue performance should be able to subdue the effects of inflationary pressures. Then for the sector you mentioned, like consumer goods, I think that's the one that investors might want to be very mindful of.
All right, then. Thank you so much for that, Luke Ofojebe, the head of research at Vetiva Capital.